Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. I've got Twitter up. We're going to go over some Twitter information. If you want to follow me, it's Finding Value Finance or at Finding_Finance if you want to follow. And I've been retweeting. I post stuff on Twitter as well with large updates, like precious metals, commodities, some ratios and stuff like that. So let's dive in here. I've got some good information to share. I think it's just funny. I'm in the housing bull camp. I'm a rare breed, apparently. Everyone else thinks that we're just going to crash in the housing market and real estate's going to fall apart and end up in a ball of fire. I don't think so. I think that we're actually going higher. And we got some information here. We'll start with that and we'll continue in to a lot of commodity different stuff. So zooming in here, it says, where's the massive surge in supply that housing bears are anticipating? Still well below pre-COVID levels when prices were still increasing, mind you. So looking at this, it says if we look at the same data in year-over-year format, we can see how the slope has changed in the last few weeks. Even allowing for decent jumps in inventory weekly in August, we'll still end of the year with only 535,000 houses on the market. Do we have to revise the forecast downward, meaning that there's less inventory? This is the active inventory and projected for single-family homes. This is 2016. 2016 was still a year where real estate was increasing. We were increasing dramatically from 2016 and onward. Here's 2022 projected. And if you look at the most recent numbers, they're starting to roll over already. So is this too aggressive for inventory? And should we revise it lower? I don't know. It's possible. One thing that I want you to notice here is the seasonality in this trend. Inventory usually declines in the February, March, April timeframe. It expands coming up, and then we decline past that. So there's seasonality to all of these things. And what people do is they'll take maybe perhaps active inventory, they'll look at it from a specific viewpoint and then tell everyone, well, month over month, it's going up and it's radically increasing. And it's like, guys, it's seasonality. Just calm down. There's going to be times where the steepness of this seasonality will be more steep than others. And there'll be times where this will shift left and right based off of the market and the sentiment in the market and interest rates and a whole bunch of different factors. What you need to do is you say, all right, when inventory gets way up here and we're at like 2 or 3 or 4 million, then I'll start to worry. We aren't even close to that yet. And again, I don't know what necessarily this future is going to do, but we're at super low levels and it's barely moving higher than the strongest year I think ever recorded, which was 2021 and the beginning of 2022. So everybody needs to just calm down here and just let the data work its way out. And it's going to take years for this to come back, I think. Come back to normal levels, I should say. So there's housing there. Here's platinum. Uselink posted, this could be a pivotal week for platinum in the short to medium term. We're starting to break out of this downtrend. We've got a whole bunch of different wedges that are forming, and we're starting to try to break above everything. We're still hitting some resistance in some of these wedges. You can see that silver is just rocketing higher, and palladium's also moving higher too. And I think platinum will benefit from the entire precious metals complex moving higher. Here's gold. Gold is ready to break out here. He's got trying to break out freedom from this resistance line, which is constraining the price of gold. I think we'll break here at any point and move on higher. So that's looking good. So that's the whole precious metals complex there. Coming down, it says after 10 consecutive weeks of builds, Chinese onshore crude inventory drew last week as the country reopens from zero COVID policy. Increased consumption within China is set to further strain an already tight oil market, taking prices up with it. So we've had some reprieve here, some loosening of the demand from China, India, Japan, and South Korea. But it looks like those lockdowns are ending and the tightness is starting to begin in the oil markets over there. That's going to tighten the entire market worldwide, with them having stronger demand in those areas. Here's another OPEC Plus unwinding their production cuts and another month of declining exports. Rapid internal demand growth and fuel oil consumption for summer power gen will further reduce volumes available for export and add pressure to an already tight physical market. This is OPEC Plus seaborne crude exports. They are declining. So how is this all going to work itself out? Noticed in 2018, they were exporting 5 million barrels. Now we're at 3 million and less. How's it going to work if China is wanting more oil? Their restrictions are loosening. And our strategic petroleum reserves will end up ending at some point. We're gonna have a really tight physical market coming up at the end of 2022 here. We've got, after 50 plus years of producing oil from prolific conventional reservoirs for less than $5 a barrel, production costs in OPEC, such as Kuwait, are continually rising as their fields mature. And when fields mature, you get a decline rate, and it gets harder and harder to extract the oil. You get less oil too. So world's easy oil is becoming more expensive to produce and in terminal decline. Invest accordingly. And this is the per barrel upstream costs continue to increase for a lot of these countries that historically have had very cheap oil. The cheap oil is ceasing to exist. What's left is hard to get, more expensive oil. And at some point, when we deplete the easy to get oil, we are going to be left with a world that doesn't look the same. It's going to be unrecognizable. Energy is going to carry a premium, and energy is the basis of life. So I think energy is going to be an incredibly good investment long term. Here's Josh Young on a article. Oil still set to top 120 by year end. That's what it's still in the articles that are out there. Now here's something. According to Gas Buddy data weekly, Sunday through Saturday, U.S. gasoline demand fell 0.01% from the prior week and was 2.6% above the average of the last 4 weeks. And this is the increase in gasoline demand per barrels a day. So we're still increasing there for gasoline. No demand destruction. Grady says the commodities bull started back in 2020 and will last 10 years. All sectors will have huge highs and lows. Big declines within a secular bull market is normal. They do not mean the bull is over. End of the rainbow, getting out of the rat race type stuff. He's just saying it's a big pot of gold at the end of this, and you can get out of your rat race if you want to by investing in commodities. Here's LBMA. Silver inventories declined another 4.7% in July. Nearly 50 million ounces left their vaults, and COMEX vaults are declining at the same time. So this isn't moving metal between the two exchanges like in summer of 2020. The silver drain continues. And this is the LBMA silver ounces draining way down. You can see that nice big drain. I don't see it turning around. We're going to get tight. Here's John, the gold-silver ratio. Silver's about to rock and roll. Inflation Reduction Act, irony of life. And what this is he's got a nice little trend line going through here. That's the ultimate line we have to break to the downside. This is the gold to silver ratio. It is incredibly cheap, but we're starting to get some headway where I think this could break down. I agree with his analysis. We'll probably pause at the long-term trend, get a relief rally, and then try to break lower. So yeah, I think it looks good, and I think silver could outperform gold here. And I think the other precious metals will also do very well. A massive breakdown of the 36-year top confirmed for the US dollar purchasing power. I know a lot of people focus on the DXY, but I thought this was pretty interesting to look at the US dollar purchasing power, and we're continuing to break down that support level. We've got a support level here, there, and we've got a whole bunch coming through here multiple times. We're starting to break down on all on that level of support resistance area or zone. And gold and silver miners went ballistic as it went below this support level. We're breaking down below that support. A June 2022 close below the breakdown line, and gold and silver miners go ballistic. They went ballistic last time in the 70s, and I think that's going to happen again. You can look at the XAU to gold ratio. You can look at all these things. The miners are cheap against everything. So I do think that he is right, Patrick, on that the gold and silver miners could do some crazy stuff. North Star posted this. This is Kevin. I think it's a pretty cool chart. What this is the NASDAQ versus the PPI, Producer Price Index in all commodities. And it's a very simple chart. Basically, it rises under these periods where the NASDAQ outperforms the PPI. And then on the downsides, the PPI outperforms the NASDAQ. And we're going into a period where the PPI is going to outperform the NASDAQ and stocks. What this means is that the NASDAQ is going to go into a longer, prolonged bear market, and that the PPI, the Producer Price Index for all commodities, is going to be favorable because it's going to outperform. That's basically saying that we're in a commodity bull market. And he has here, note the rotation of money doesn't just involve gold, but all manner of hard asset commodities at various times to varying degrees. When the chart turned down in 2000, it took a while for precious metals to really start moving. The capital flows really kicked in when we got the bearish cross and we moved below the cloud. That hasn't quite happened yet, but it appears that it could be close to breaking below that cloud. Looking at Eric, it says the optimism towards oil, as measured by the net length in oil contracts, is now the lowest since the price of oil went negative in April of 2020. Pretty amazing. While much of the world is plunged into an energy crisis, and OPEC just last week warned of spare capacity exhaustion. So not a lot of people are net long in oil contracts. I think that we could see a little bit of weakness here, and then it's going to be go time soon, at some point this fall. North Star had a really nice chart here. I do like this one. What this is the S&P 500 in relationship to that PPI. It's not the NASDAQ, it's the S&P 500 this time. And again, every time we've broken the uptrend line, we've had a good decade-long plus consolidation period. Consolidation period. And now we're breaking down into another, I think, decade-long consolidation period where the Producer Price Index of commodities will outperform stocks. So not only is it happening against the NASDAQ, it's happening against the S&P 500. And I think that this is going to be a commodity bull market that's coming, and this is just more information showing that. Gold miners are almost paying more dividends than utility stocks for the first time in history of the data. This is the S&P utility sector going back. This here is the dividends being paid by gold miners, and they're starting to cross here. Something that is changing over time. And if we go into this large commodities bull market, we may see things different and change versus history, in time. Never seen before. He's talking about the rate of change in the interest rates. Now, I know we're coming off of very low levels, incredibly low, and the rate of change would be very great coming from such low levels. But it is a rate of change that the market has to deal with. So we're used to these really low rates, and now the rate of change is quite dramatic. And we're going to see things happen in the markets that we perhaps have never seen before because the rate of change has changed so much in such a rapid period. We could also maybe perhaps make an observation here that maybe we are in a war, a currency war, and that the rate of change has to do this because we've never seen such a problem in history. Maybe this is telling us that something in the markets is wrong and that it's bigger than what most people think, and that maybe perhaps it's a currency war. I'm not exactly sure, but it could be. It could be because the rate of change is so great here. This is you got what I need. Exactly, guys. New higher level here, and we could be breaking this resistance line to a much higher level in the future out in 2023. And this is a nice little chart of UUUU, a projected move breaking from this level into a new higher level was 198%. If it were to repeat that and do it again, we could break into a new higher level, which could be more towards the $33 range or something like that. Big moves could be coming in uranium. Here's another one. Amplan sees pickup and switch to platinum from palladium. They are doing those substitutions. And platinum would be the metal to have in that type of situation because it is the cheapest metal on a historical basis. It says U.S. diesel shortage shows economy hitting capacity limits. U.S. distillate fuel oil inventory are depleting to critically low levels. Either an imminent recession reduces consumption or prices are likely to surge higher. I think they're going to surge higher. That's what I think. The U.S. unemployment rate moved down to 3.5% in July, back to pre-pandemic levels, which are the lowest we've seen since 1969. This here looks to me like it's setting up for a 1970s type move. In this three-wave move was a highly inflationary period. What this is indicating to us, the U.S. employment rate, could be that we are entering a new bull market in commodities and an inflationary period. With the inflation low, with all of the money in the system and in checkable deposits, we could see something like a 1970s type movement coming up here very soon. It also means that we would be positioned more like 2001, where we could have a recession first and then a big move all the way into 2008. That was a two-wave move. This is a three-wave move into 1980. So that's what we've got there for the unemployment rate. And I'll end it there, guys. Lots of good information there across kind of the spectrum. I am still huge on the commodity bull market happening. I think we're super early in it, and I'm remaining long for this next decade for commodities. That's where I think the opportunities are. That's where I'm going to be, and why am I going to try trading this stuff? It's very difficult to trade the short term. I don't think too many people are very good at it. I know they're not because the returns are not that great. So I'm going to go long, stay long, accumulate on pullbacks, and ride this bull market higher. It's going to be a gigantic one, I think, much like the 1970s. The 1970s entered that bull market with an energy crisis. We're entering this one with an energy crisis. So there's a lot of parallels that we can draw to the 1970s in terms of energy and how commodities are positioned for this bull market. And I think the best way to play it is to get long in some of these commodities and just stay long. If you guys need help on identifying what companies that I'm playing, you can look at the description link below, become a platinum member, and you can see how I'm playing this commodity bull market that's coming up. If you guys like this content and you just want to follow me on YouTube, definitely subscribe to the YouTube channel. Give me a thumbs up. Help me out. And if you want to follow me on Twitter, that's at @finding_finance. Hopefully you guys enjoyed the clip. We'll catch you next time. This is Finding Value.